In this video, we're going to go over Chapter 3, looking at taxes, and there's quite a bit of information in here, and one of the things I've tried to do is update it for the new tax laws that have come into play starting for 2018. Now, the learning objectives identify the different types of taxes, begin to calculate the taxable income that you might have. It would be nice if we could take some time to prepare a federal income tax return. That may be something that you need to practice with on your own. And then start thinking about appropriate tax strategies based on what it is that you're doing and what your life is really all about. One of the things you want to do is make sure that you're clear as far as what taxes you need to pay and what's actually going on. As it says down here at the bottom, paying your fair share, but still taking advantage of all the tax breaks and the tax benefits that you can. I have a guy who does my taxes. He's the CFO for a company here in town, one of my golf and poker buddies. And I tell him, I say, Bill, I have two goals. Pay as little tax as possible and keep my butt out of jail. And so that's exactly what we're trying to do here. Now, there's different types of taxes that we need to think about. A lot of times when people think about taxes and all the things that are going on that you hear about in the news, they're talking about taxes on earnings. Okay, your income taxes, your federal income taxes. Folks, you pay so much more in taxes, it's unbelievable. Things that you don't even think about. For example, all of the purchases that you make. If you buy something in Overland Park, you're going to be paying a tax of 9.6%, almost 10%. So when you go and you buy that $5 cup of Charbucks coffee, you're paying almost another 50 cents in just taxes. That breaks down. Kansas tax, sales tax, the state of Kansas is 6.5%. Overland Park charges another 1.6%. Johnson County, another 1.5%. Every time you go out and buy gas, every gallon of gas has almost 50 cents of tax for every gallon. 31 cents going to Kansas and 15 cents for the federal side. You're going to be paying taxes on your property. So if you have real estate, you're going to be paying about 1.5% of the value of your property every year in taxes. Then you also have your personal property tax. In other words, every year you're going to have to pay a tax on your car. Just the fact of owning the car, you're going to have to pay the tax on that. There are other taxes, estate taxes. Okay, somebody passes away, depending upon the value of the estate. Whoever is receiving the estate will have to pay taxes on that. As far as inheritances, death taxes, things like that. Folks, we pay so much in the way of taxes, it's unbelievable. And a lot of times we don't even think about it. Now, when you start thinking about your federal income tax, what you have to do is calculate what's called your adjusted gross income. All right? That starts with all the taxable income that you may have. So, for example, at the end of the year, you're going to get W-2s from the people that you have worked for. You may also get 1099s. A 1099 is a form that says, okay, you got this kind of income, we paid you this, but you didn't work for us. And so you have to pay tax on that as earned income. And exclusion, you may hear about exclusions. Exclusions are amounts that are not included in your gross income. You pull that information, that amount out. Tax-exempt income is income that somebody might receive that is not subject to tax. Now, check with your tax professionals on that. Tax-deferred income is stuff that gets taxed in later years. Now, you may have adjustments to your income, so you can reduce your gross income by certain adjustments. All right? For example, you make a contribution to a traditional IRA or a KEO plan. In other words, retirement plans. That can reduce your adjusted gross income. Tax shelters allow you to avoid some of the taxes that might be necessary. Now, when you're computing your taxable income, you have tax deductions. Now, with the new tax laws that have come into play, the standard deduction is $12,000 for a single person, $24,000 for a married couple. In other words, one of the things that's happened is the standard deduction has been raised so much, many times, that is much more beneficial for taxpayers now than itemizing. You also can itemize some of the deductions. In other words, there are certain things that can be deducted from your taxable income, such as mortgage interest and some of the other things. And so what you do is you come up and identify and calculate what your adjusted gross income is. Then what you do is you start looking at some of the other things that can be taken out. So for example, medical expenses. As of the new tax laws, you have to have, your medical expenses have to be at least 7.5% of your adjusted gross. You can deduct your state and local taxes. However, with the new tax law, you cannot, the maximum that you can deduct is $10,000. And that means all of your state taxes, all of your property taxes, all of your personal taxes, and things like that. You can deduct interest that you may have paid. For example, you have a mortgage, and you're paying interest on that as you pay it off. You can deduct that. Some of the contributions that you may make to nonprofits. Casualty and theft losses can be deducted, but based on the new tax law, only if it was due to a federal disaster. So in other words, a hurricane comes through and wipes out your house, or something along those lines. You're moving. Maybe you're moving for your job. As long as it's beyond a certain mileage, you can deduct the expenses for that. And then any other kind of job-related expenses. In other words, expenses that you had to put out in order to keep your job or to do your job, as long as those were at least 2% of your adjusted gross. In computing your taxable income, you get your gross less your adjustments, all right? Less any kind of standard deductions or itemized deductions to get your taxable income. Then what you do is you calculate your taxes based on the tax tables, less any kind of credits that you may have earned, plus any kind of other taxes that might be necessary, and that's your total tax due, or if you have paid in more than what is due, you'll get a refund. One of the things that's necessary is to make sure you have good record keeping. So you have your tax forms and your filing information, and again, that's something that you want to keep for quite a while. Your income records, so in other words, W-2s from the places that you worked. 1099s, in other words, you'll get a 1099 from your bank saying that they paid you this much in interest for your savings account or something like that. 1099 forms for self-employment. One of the things that I've been doing for a number of years, I am self-employed. And so I will do work for a customer. They will pay me based on the invoice that I send them. I have to pay estimated taxes on that quarterly. They'll send me a 1099 at the end of the year, and they also report that to the IRS. So I need to make sure that I'm keeping track of all that. Then any kind of expense records that you may have. Now, in computing your taxable income, all right, it used to be that you could have some exemptions. So in other words, you had $4,000 per person that may be on there. As of the new tax law, as of 2018, there are no more personal exemptions that you can take off and reduce your adjusted gross. So what you do is you go to the tax tables and look at the marginal rates. Now what that means, these are the new tax tables based on the 2018 tax law. If you had income that was between zero, you didn't earn anything, and $9,500, you're going to pay 10%. If you had income up to $38,000, you're going to pay that 10% on that first $9,500 and then 12% over the amount above the $9,500. So let's say that you had $29,525 as far as your income is concerned. You'll pay 10% on the first $95.25, which is $952. Then you'll pay 12% on that $20,000 above the $9,500. All right? So what this says is between these amounts, you will pay this plus 22% above the $38,700. So that's the way the tax tables work, and that's for individuals. If you are married and filing a joint return, they look like this. Now, what's happened with the 2018 tax brackets, they actually reduced the percentages that you see here, except for the top bracket. They actually raised that. And the amounts that they put in here were actually raised. So what was happening is most people are going to be paying less in taxes based on the new tax laws. One of the things that you'll identify is what your average tax rate is. Okay, so let's say that you have taxable income of $50,000, your total tax bill is this. Your average tax rate, what you do is you just divide what you paid versus your taxable income to get your average tax rate. The marginal rate may have been 30%, but the average is this. That's something to think about. This is just an example that shows how you would calculate the taxes, and this is based on the 2017 amounts. You can see that they are higher than they are in 2018. Now, there's also what's called the alternative minimum tax. You may hear about that. People who have a high deduction and various types of incomes, and a lot of times it's high income, sometimes will have to pay the alternative minimum tax. Tax credits are things that it's almost as if you had already paid the tax. See, a tax deduction will reduce the amount of tax based on your marginal rate. Tax credits are 100% given back to you. One of the things that we need to think about is how we make our tax payments. Most times when we're working someplace, they're going to withhold the taxes for us, and they report that to the IRS. If you are self-employed and you are, like I am, you send out invoices and you're collecting the income from that, then what you do is you make estimated quarterly payments. You need to make sure that you get your taxes filed by April 15th. Now, you can ask for an extension. The thing is, when you ask for an extension, you have to pay all taxes that you think you owe up to that point. Then what will happen is anything after that, as far as filling out the forms, getting those things in, then you may have to pay some more. You may get a refund back. It just depends. If you are underpaying too much as far as your taxes are concerned, you could have to pay interest on the amount that was owed, or you could have penalties that you have to pay. Now, there are 5 filing status categories. Okay, single, married filing jointly, filing separately, head of household, qualifying widow or widower. So you need to make sure you know how you are going to, what category you fall into. And there's all kinds of forms that are being used. There's about 800 federal tax forms, depending upon what it is that you're doing. Excuse me, most people are using the 1040EZ or the 1040A or the 1040. For me personally, I use the 1040, and because I have a business, I also have some other forms that have to be filled out that show what my income was, what my expenses were, things like this. Main thing is to check with your tax preparer. Also, make sure you go over the instructions for doing the taxes. There are major sections in the Form 1040. What is your status? What kind of income did you have? What kind of adjustments? What your tax is? Any kind of credits? And then anything else that you need to owe. Now, it says other taxes, such as from self-employment. When you work someplace, they're going to take out 7.5% for Medicare and Social Security. They are also, your company, the company that you work for, is also paying another 7.5% for that Social Security and Medicare. If you are self-employed, you have to pay both. You have to pay the entire 15%, and some of the other taxes come in for there. It'll show payments. In other words, what is it that you've already withheld or what you submitted through quarterly payments, and then you can figure out what kind of refund or what it is that you owe. Then you sign the form. That tends to be the most common filing error. People will complete the form and everything, but not sign it. You have to sign it. Almost all states have a state income tax, all but 7. The Delaware, Florida, and several others do not have a state income tax. Now, these are the 2018 tax amounts for the state of Kansas. So if you had taxable income less than $15,000, they're going to charge you 3.1% on what it is that you earned. If you had taxable income over 15 but not over 30, now this is taxable income, all right, this is the adjusted gross. You're going to pay $465 plus 5.25%. That's if you're single. If you're married filing jointly, the amounts are basically doubled. So you can see that you're going to be paying more, even more taxes in your state. When you file, it used to be that you had to mail the stuff in. Well, most times what's happening now is people are e-filing. For example, the guy that does my taxes, he does the e-filing. If you have somebody else, such as an H&R Block or somebody, do your taxes, they will e-file it. There's various things that you can do as far as doing that online. There's the Free File Alliance, all right, so that will help you with that. You could go to the IRS website and go ahead and just do it yourself. You could also get tax preparation services. H&R Block is huge, all right. You can get a software called TurboTax, and I think there's some other pieces of software also that will help you with it, that allows you to fill out the forms, do everything, and then file online if you want. When you think about getting tax assistance services, okay, the IRS can help you out, although during this time of year, good luck getting hold of someone. All right, they're going to be very backed up as far as their phone calls and things like that are concerned. You could also just go to an IRS office. That might help you out there. You could also go to other services such as H&R Block or something along those lines. They'll charge you for it. Remember, nothing is free, okay? They will charge you for it. Maybe you have some really complicated stuff. Get a CPA or a tax accountant that will help you with it. And a lot of times, attorneys can also help with that. When you're thinking about somebody else doing your taxes for you, you better be making sure that you're shopping around. You understand who it is that you're dealing with. There have been situations where some of these tax preparers, the people who are in some of these offices, are not as well trained as they should be. If you have something that's relatively simple, they don't have a problem with it. If you have something that is more involved and in depth, I've seen some where they've made some mistakes and people are paying more tax than what they should. All right, now, what if you get audited? Okay, a tax audit is where the IRS comes back and says, wait a minute, there's a question as far as your return is concerned. Make sure that you keep all of your receipts, any kind of canceled checks, all of the forms that are necessary. Again, what we're talking about here is making sure that you're keeping track of all of your data that's needed in your money management aspect. When you start talking about who is it that's getting audited, in 2017, only about 0.5% of all returns are audited. And so the chances of you being audited are pretty slim. If you have large, unusual deductions, if you're showing that you had a huge amount of income one year and like nothing this year, you're going to get audited. Now, there's 3 types of audits that they'll do. There's the correspondence audit, office audit, and the field audit. Correspondence audit is where they just send you a letter in the mail and say, okay, here's some questions, answer the questions and send it in. About 71% of all audits are nothing but correspondence audits. Office audits take place at an IRS office. Field audits are normally done for businesses, not necessarily for individuals. If you do get audited, you can request time to get everything prepared, get all of your data together, get all of your receipts together, things like that. If you have results that are negative to you, you do have the right to appeal any kind of results that they may have. When you are audited, make sure that you think about, is your tax preparer or accountant going to go with you? Sometimes they won't. So you have to make sure that you're clear. If you're going to have somebody else do your taxes, will you go with me if I get audited and I have to go to the IRS offices? Make sure you're on time and bring only the things that are necessary. Stay chilly, folks. Don't get upset or anything like that. Stay positive, all right? And make sure that everything you've done is consistent with the laws. Now, one of the things to think about is your tax planning strategies. It's okay to avoid taxes wherever possible. In other words, are there things that you can do that can reduce the amount of tax that you pay? Tax evasion is illegal. In other words, not paying the taxes deliberately can put you in jail. This talks about trying to minimize your taxes owed. If you have the same or a lower rate, try to accelerate any kind of deductions, although the number of deductions that you can get down is going down. Education deductions is something to think about. Check with your tax preparer as far as what you can do as far as any of your education deductions that you might be able to take. Consumer purchases are something to think about. Okay, in other words, did you buy a house? Okay, that's going to help you out as far as some of your taxes are concerned. When it comes to some of the debt, you may hear about a lot of the commercials where they're saying, okay, get a second mortgage or redo your mortgage and you have money to pay off your debts. What you're doing there is you are refinancing your house and you're actually borrowing the money to pay off some of the credit cards. It will help you because chances are you're going to get a lower interest rate than what a credit card would have. Plus, you can deduct the interest depending on the amount of deductions that you have. Also, think about your investment decisions. There are tax-exempt investments. We'll talk about this later on when you start talking about things like municipal bonds and things like that. And there are tax-deferred investments. In other words, maybe you have a health savings account. You're putting money into a health savings account to be used to go to the doctor to handle the co-payments and deductibles that you may have for any kind of health care needs that you might have. That goes into those accounts pre-tax, so you're not paying as much tax on that. And also think about retirement and some of the retirement plans that you can have, traditional and Roth IRAs and KEOs and things like that. We'll talk more about that a little bit later on in the semester. You may also hear a couple of other terms. One is called a flat tax and a VAT, a value-added tax. Flat tax is where everybody pays the same rate. Everybody pays 10% or something like that. Some of the studies that have been done have been shown that if you get rid of all of the other deductions and things like this, a flat tax could actually bring in more money to the Treasury than the convoluted tax code that we currently have. Others say, okay, well, the wealthy have to pay more as far as taxes are concerned, a very progressive tax approach versus the lower income folks. Value-added tax, this is typically done in Europe, where a tax, instead of like a sales tax, what happens is every time a product goes through any kind of changes. So for example, you get raw materials and somebody makes stuff from that, and then what they do is they sell it. As it goes through that value stream, there is a tax that's added to that because you've just added value to this. And so what happens is when you purchase the product, you are actually paying all of those taxes that have been passed through as far as the value is concerned. So those are the key points as far as Chapter 3. Again, one of the things I suggest you do if you want to learn more about taxes is to check with your tax preparer to make sure that you understand what it is that you need to pay, you understand how the taxes are being done, and that sort of thing. If you have questions, give me a shout.